The US economic downturn is colliding with a silent but growing threat, the pension crisis. As the population ages and the system is strained by increasing obligations, promises to workers face an uncertain future. This video explores the prisoner ghost and the potential economic risks threatening the aging West. The sun sets over a quiet suburban street in the American Midwest, where the manicured lawns and silent porches mask a mathematical certainty that few are willing to name. We begin with the image of a promise, a social contract signed decades ago that guaranteed dignity in exchange for a lifetime of labor. But in the hushed corridors of pension fund headquarters and the sterile offices of government actuaries, a phantom is stirring. It is the pension ghost, the invisible weight of trillions of dollars in unfunded liabilities that now haunts the global financial system. For the first time in history, the demographic pyramid has inverted. The workers of today are being outpaced by the retirees of tomorrow, creating a structural imbalance that threatens to swallow the wealth of entire nations. As we watch the clock tick toward a massive demographic cliff, we must confront the reality that the safety net we built is fraying under the pressure of aging populations and stagnating birth rates. The silence of this crisis is its most dangerous trait. It does not arrive with the roar of a stock market crash, but with the quiet, persistent drain on the liquidity of our future. We are standing at the edge of a new economic era, where the ghosts of past promises are coming to collect a debt that the current generation may never be able to pay in full. The signs of this unfolding crisis are etched into the balance sheets of municipalities from Chicago to Tokyo. When a pension fund's expected rate of return fails to meet its obligations, the gap is often filled with creative accounting or high-risk investments that jeopardize the very stability they seek to provide. We see the symptoms in the rising credit default swaps for cities burdened by legacy costs, signaling a growing lack of confidence in their ability to stay solvent. Real estate markets in aging districts begin to stagnate as a smaller pool of young buyers struggles to absorb the inventory left by a departing generation. The liquidity that once fueled economic expansion is increasingly diverted to meet fixed retirement payments, leaving less for infrastructure, education, or innovation. This is the gray squeeze, where the vibrancy of the economy is slowly choked by the cost of its own history. In the grocery aisles, the crisis manifests as shrinkflation and rising costs that hit those on fixed incomes the hardest. It is a slow-motion collision between the rising cost of longevity and the diminishing returns of a shrinking workforce. The warning lights are flashing red in the bond markets, yet the public remains largely unaware that the foundation of their future security is being hollowed out by a demographic shift that no amount of central bank intervention can fully reverse. The mechanism of a pension-driven shock is often a sudden flight to quality, as investors realize that the tax base of an aging nation can no longer support its debt. When interest rates rise to combat inflation, the discounted present value of pension liabilities actually shrinks, but the cost of servicing the government debt used to plug the gaps skyrockets. This creates a liquidity trap. Unlike the 1997 IMF crisis, where the shock was triggered by external currency speculation, the pension shock is internal and systemic. It moves through the economy like a slow-burning fire. As funds become desperate for yield, they move into alternative assets like private equity and high-stakes real estate, creating bubbles that are highly sensitive to interest rate hikes. When these bubbles burst, the pension ghost materializes as a sudden demand for taxpayer bailouts. The shock is felt most acutely when a municipality or state is forced to choose between cutting the checks of retired police officers and teachers or maintaining the basic services of a functioning city. This choice triggers a downward spiral. Higher taxes on the young to pay for the old lead to an exodus of the productive workforce, further shrinking the tax base and accelerating the collapse of the social contract. Global case studies serve as a laboratory for this impending disaster. In Greece, the pension crisis was a central pillar of its sovereign debt collapse, where retirees saw their benefits slashed by 40% as the nation traded its social safety net for international bailouts. Argentina provides a more radical example, where the government once nationalized private pension funds to pay off immediate debts, effectively vaporizing the long-term security of its citizens to survive a short-term liquidity crisis. In Japan, the silver democracy has led to decades of stagnant growth and a debt-to-GDP ratio that exceeds 250%, as the government borrows from the future to sustain a shrinking present. Even Turkey and Venezuela have seen how hyperinflation can act as a soft default on pensions, where the monthly check still arrives but can no longer buy a loaf of bread. These cases demonstrate that there are only three ways out of a pension deficit: default, inflation, or radical demographic expansion. Each path carries a heavy price. The IMF 1,997 lessons remind us that when the math stops working, the market doesn't care about the sanctity of a promise. It only cares about the solvency of the ledger, leaving millions of elderly citizens vulnerable to the cold logic of global finance. In the United States, the impact is a quiet erosion of the American dream. The Social Security Trust Fund is projected to be depleted within the next decade, a milestone that will trigger automatic benefit cuts unless drastic legislative action is taken. But the crisis is deeper than just federal programs. It is the thousands of corporate and state-level defined benefit plans that are underwater. This has a direct impact on the housing market, as the older generation holds on to larger homes as their only remaining bank, preventing a younger, debt-burdened generation from building their own equity. The pension ghost manifests as a generational transfer of wealth in reverse, where the young pay higher payroll taxes for benefits they are told will likely not exist for them. This creates a secondary impact on consumer spending. If the middle class must save aggressively to compensate for a failing pension system, the velocity of money slows, dragging down GDP growth. The US economy is becoming a maintenance economy, where an increasing share of national income is dedicated to past obligations rather than future investments. This stagnation is the price of a system that assumed the population would grow forever, leaving the individual to navigate a landscape where the safety net is more of a decorative tapestry than a functional tool. In the United States, the impact is a quiet erosion of the American dream. The Social Security Trust Fund is projected to be depleted within the next decade, a milestone that will trigger automatic benefit cuts unless drastic legislative action is taken. But the crisis is deeper than just federal programs. It is the thousands of corporate and state-level defined benefit plans that are underwater. This has a direct impact on the housing market, as the older generation holds on to larger homes as their only remaining bank, preventing a younger, debt-burdened generation from building their own equity. The pension ghost manifests as a generational transfer of wealth in reverse, where the young pay higher payroll taxes for benefits they are told will likely not exist for them. This creates a secondary impact on consumer spending. If the middle class must save aggressively to compensate for a failing pension system, the velocity of money slows, dragging down GDP growth. The US economy is becoming a maintenance economy, where an increasing share of national income is dedicated to past obligations rather than future investments. This stagnation is the price of a system that assumed the population would grow forever, leaving the individual to navigate a landscape where the safety net is more of a decorative tapestry than a functional tool. For the individual, personal survival strategies must shift from passive reliance to active defensive positioning. In an era of the pension ghost, the most dangerous assumption is that someone else will provide for your final decades. Diversification is no longer just a suggestion, it is a necessity. This means looking beyond traditional retirement accounts and seeking real assets that can withstand currency devaluation, such as modest real estate or equity in productive businesses. One must also hedge against the tax of the future by utilizing Roth-style accounts where taxes are paid upfront, protecting against the inevitable rate hikes that governments will use to fill pension gaps. Understanding the exchange rate between your labor and the future cost of living is vital. Another critical strategy is the longevity hedge, investing in one's own health and skill sets to remain productive longer, as the traditional 5-year-old retirement becomes a relic of the past. The useful insight for the viewer is to view Social Security as a bonus, not a foundation. By reducing personal debt and lowering your cost of survival now, you create the liquidity needed to weather the shocks when the state-level systems inevitably recalibrate. True security in the aging West is not a promise on a government document. It is the resilience of a private balance sheet. The remarkable closing message of this documentary is one of sober realization and the power of transparency. The pension ghost is not a monster that can be slain with a single policy, but it is a challenge that can be managed if we face the numbers with honesty. We are witnessing the end of the Ponzi-style demographic model, and while the transition is painful, it offers a chance to build a more sustainable social contract. A world where we value labor and productivity over mere longevity is possible, but it requires us to stop pretending that the math of 1,950 applies to 2025. The crisis of the aging West is a call to innovate, to automate the mundane, to redefine what work looks like in our later years, and to ensure that wealth is not just hoarded by the past, but invested in the future. As we have seen, the nations that survive this transition are those that adapt their institutions to the reality of their people. The ghost only has power as long as we remain in the dark. By bringing these liabilities into the light and taking personal responsibility for our financial destiny, we can turn a looming crisis into a period of profound restructuring. The future belongs not to the system that promised the most, but to the people who were prepared for the truth. The era of the pension is ending. The era of personal and community resilience is just beginning. Beneath the cold statistics lies the human story of the Great Disconnect. We see it in the eyes of a retired teacher who must choose between her medication and her heating bill, realizing too late that her decades of service were banked in a system that didn't account for the volatility of the 21st century. This is the moral dimension of the pension crisis. It creates a zero-sum game between the grandmother and the grandson, where every dollar spent on a pension is a dollar not spent on a school or a bridge. This generational tension is the hidden engine of modern political polarization. As the pension ghost haunts the voting booth, we see the rise of populism as a reaction to the perceived broken promises of the elite. To heal this, we must move toward a transparent equity model, where the obligations of the state are clearly defined and the risks are shared more equitably across the lifespan. The insight for the viewer is that economic stability is a shared responsibility. We cannot have a wealthy retirement in a bankrupt society. We must reinvest in the productive capacity of the young to ensure there is an economy left to provide for the old. The human impact is a reminder that at the heart of every economic indicator is a person's life, and that life deserves more than a ghost of a promise. As the final credits roll over, images of bustling cities and quiet retirement homes, the ultimate lesson remains. The economy is a reflection of our collective values. The looming crisis of the aging West is a test of our ability to adapt to a world that looks nothing like the one our grandparents built. We have the tools, the technology, the capital, and the data to navigate this demographic cliff, but we lack the political will to speak the truth. The pension ghost is a phantom of our own making, born from a desire for comfort without cost. To move forward, we must embrace a new realism. This involves a shift towards sovereign wealth models that invest in the global economy rather than just domestic debt, and a culture that prizes financial literacy from the classroom to the boardroom. Your path forward is to be the architect of your own security, to look at the signs of crisis not with fear, but as a signal to change course. The sun rises on a new demographic landscape. It is a world that is older, perhaps slower, but one that can still be prosperous if we choose to build on a foundation of reality rather than a mountain of debt. The ghost is only a shadow. The light of informed action can dispel it, ensuring that the dignity of the elderly and the opportunity of the young are no longer at odds, but are the twin pillars of a renewed and resilient civilization.